Interested in a career in high finance? Are you keen to join a hedge fund? Dazzled about how hedge funds invest? Let's take a look at different strategies of hedge fund investing and analyze the performance of these hedge funds. Hello, everybody. I'm your learning partner, Sushila Hariharan. And if you are interested in a career in fund accounting, corporate actions, trade life cycle, and OTC derivatives, then do subscribe to my YouTube channel because not only do I post videos like this, I also post quizzes regularly, and you can participate in the quiz and test your knowledge. Hedge funds are financial sponsors with a general partner who contribute towards the capital and run the fund. Along with the limited partners, they form the asset management company, and the hedge fund is described as a specific hedge fund if it has chosen to invest in a particular manner or a particular set of assets. Therefore, in this video, let's take a look at what are the strategies that hedge funds employ to be able to invest in different markets. The first strategy is global macro strategies. Global macroeconomics implies that you're investing in different markets, different currencies, different assets, and different countries across the world. The global macro strategy could involve investing in a single country or maybe a few countries of that region. For example, Asian economies or even emerging economies. For example, BRICS countries investing. These could all be global macro strategies. These are multi-asset strategies. That means they could invest in equities, fixed income, currency, commodities, etc. The interest rate movements in the particular country and the difference between that country's interest rate movements and those of USD are the prime driver for global macro strategies. Some of the global macro strategies could also bet on events like Brexit, which affects the performance of all countries, as well as all assets of the specific country which is exiting the European Union. Some strategies of hedge funds could be long short strategies. Long means the hedge fund has taken a buy position in that, and short position means that hedge fund has sold a particular asset. So a long short strategy in equities means you're expecting the equities to rise in a specific basket of equities. Short positions are taken because you're expecting the prices to fall, and when the prices actually do fall, you can cover the trade. Thus, the hedge fund is hedged on both the sides, and this makes tremendous sense for the hedge fund because they're looking at trading on both sides of the portfolio. This implies that the investment objective or the trading objective of the hedge fund is not only profit maximization but also risk minimization. So they will take dual trading positions in multiple assets. Another hedge fund strategy is investing on event news. This is called as event driven strategies. For example, taking positions in corporate restructuring, capital restructuring like mergers and acquisitions. These events cause the price to become inefficient as most traders are now trying to find out what the new price of the stock would be post the event. For example, if there is an impending demerger of a company and the company is spinning off some of its units into another company, then we have to find out the reverse of some of the parts. And by finding out the reverse of some of the parts, we'll know what is the value of the leftover assets in the parent company. These price inefficiencies are exploited by the hedge fund manager, including in mergers and acquisitions. You have pre-merger arbitrage, you have post-merger arbitrage, and this could be an opportunity for the hedge fund manager to trade on. This value could also come from distressed investing. Some of the assets of the investing company could have fallen below the acquisition cost or even fallen below the market price. So then you want to purchase the assets of that particular company. It could also be a convertible arbitrage. A convertible arbitrage is when you're taking an arbitrage opportunity in the conversion of the fixed income into equities. And you're trying to calculate whether the price of the swap ratio for fixed income to equities is profitable for the hedge fund or not. If there is any kind of mispricing, then the hedge fund swoops in like an eagle and takes in the arbitrage position. Or another event that could be a possible credit ratings downgrade. So the hedge fund would look at selling the bonds or selling the equities of that particular company in anticipation that if the downgrade actually does happen, the prices would collapse even further. Some hedge funds adopt fixed income strategies. They're not participating in the equity markets at all, but are focused on fixed income strategies. They look at specific asset classes of bonds, making investments in investment grade bonds, speculative grade bonds, and sometimes even in junk bonds. These bonds could be across different countries, like Japanese government bonds, JGBs, or samurai bonds, Japanese corporate bonds. These could be Yankee bonds, and so on. Or sometimes even matador bonds traded in Spain. This investing in bonds or trading on bonds implies a directional call on interest rate movements, and therefore, bond yields, currency rates, and credit ratings are all important aspects of understanding the fixed income strategy. Some hedge funds are short biased hedge funds. This implies that they are looking to short sell assets with a hope and or in anticipation of prices coming down and the hedge fund then being able to recover the position by buying it at a much lower price than the market. A short buy strategy includes equity driven strategies. They find the stock to be overpriced. They short sell in the spot market. They borrow the oversold stocks and they're taking a bearish view on the economy. And now, a very popular kind of a hedge fund strategy that is managed futures. Managed futures include commodity trading advisors, long positions in underpriced futures. Okay, the commodity trading advisors are the agencies who are used by hedge funds to trade in managed futures because of the nature of the underlying asset, that is, commodities. These could be long positions in underpriced futures or short positions in overpriced futures. This could be multi-asset, multi-currency strategies, and these kind of strategies are very popular with hedge funds as well. If you like the content on my videos, please like and share the videos with your friends because you ought to share knowledge with your friends and colleagues. Subscribe to my YouTube channel if you're interested in a career in fund accounting, corporate actions, trade life cycle, and OTC derivatives.